The year is 2026. You're sitting in a dimly lit San Francisco restaurant, picking at a $48 piece of branzino, when the man across the table, a man whose company just closed a $110 billion funding round at a $730 billion valuation, the largest private fundraise in human history, leans forward and says with a straight face, someone is going to lose a phenomenal amount of money. That man is Sam Altman. The company is OpenAI, and he's telling you, on the record, that the very thing he's selling you is a bubble. Here's the part that should break your brain. He says this while simultaneously signing infrastructure contracts worth over $1.15 trillion spread across Broadcom, Oracle, Microsoft, Nvidia, AMD, AWS, and CoreWeave. He says this while his projected 2026 losses balloon to $14 billion, nearly triple the year before. He says this while Nvidia, the company selling him chips, agrees to invest $100 billion into him so he can turn around and buy more chips. If your spider sense is tingling, congratulations. You have a functioning brain. But here's the twist this video is actually about. Pretty much everyone debating the AI bubble, the bulls screaming real demand, the bears screaming .com 2.0, the YouTubers, the hedge funds, the guy at your gym who just discovered ChatGPT, almost all of them are wrong. Not because one side is right and the other is wrong, because they're asking the wrong question entirely. Today, we're going to dismantle the AI bubble debate, expose what both sides are missing, and walk through the actual mechanics of the most expensive economic experiment in modern history, one that may be both a bubble and a revolution at the same time. 1. The definition problem. Why the bubble debate is mostly two people yelling past each other. Before we get into the data, let's pause and acknowledge something embarrassing. Most of the people screaming about the AI bubble cannot agree on what bubble means. And no, this isn't pedantic semantics. This is the entire reason the debate has been useless for 3 years running. The bulls, your Andy Jasseys, your Sundar Pichais, your Janus Henderson asset managers, define a bubble narrowly. To them, a bubble is when valuations detach from fundamentals, when stock prices are propped up purely by speculation, when companies have no revenue and burn cash on Super Bowl ads. They look at the AI sector and they see real revenue. They see Microsoft's AI run rate hitting $37 billion annually. They see Google Cloud's backlog ballooning to over $460 billion. They see AWS posting 28% growth in Q1 2026, its fastest in 15 quarters. So they say, this isn't a bubble. This is the biggest infrastructure build-out since the interstate highway system. The bears, your Michael Burrys, your Ray Dalio's, your counterfire columnists, define a bubble much more broadly. To them, a bubble is when capital allocation becomes irrational at the margins, when the second-tier players are valued like the first-tier players, when financing arrangements start looping back on themselves. They look at the AI sector and see OpenAI losing $14 billion a year while signing trillion-dollar contracts. They see the Shiller-Cape ratio at 40, a level seen exactly once before in recorded history in 1999. They see the 5 largest companies hoarding 30% of the entire S&P 500, the highest concentration in half a century. So they say, this is the largest, most over-leveraged speculative mania since tulip bulbs. Here's the awkward truth neither side wants to say out loud. They're both right. Brett Taylor, the chairman of OpenAI itself, basically admitted this on the record. His exact quote, "I think it is both true that AI will transform the economy, and I think we're also in a bubble, and a lot of people will lose a lot of money." Read that again. The chairman of OpenAI is openly telling you both things are happening at once. This is the part of bubble dynamics that breaks people's brains, because we like clean narratives. We want to know whether to buy or sell, whether to celebrate or panic. But every major technological bubble in modern history has been simultaneously a real revolution and a financial disaster. The British Railway Mania of the 1840s, genuinely transformed civilization, gave Britain 7 times the rail density of France or Germany by 1855 and bankrupted thousands of middle-class investors who lost everything. The fibre optic build-out of 1996 to 2000 wired America with 10 times more cable in 5 years than had ever existed before, and created a crater so deep that as much as 85% of broadband capacity sat unused as late as 2005. WorldCom and Global Crossing went bankrupt. YouTube and Netflix used their fiber. The technology was right. The investors were wrong, both at the same time. So when somebody on TV asks, "Is AI a bubble?" that question is doing a lot of stealth work. It's smuggling in an assumption that bubbles and transformations are mutually exclusive. They are not. They have never been. They almost always coexist. The actual useful questions, the ones nobody wants to ask because they're harder, are these. Which specific parts of the AI build-out are speculative and which are grounded? Where exactly is the leverage hiding because it's always hiding somewhere? Who eats the losses when the music slows down? Equity holders, like in .com, or debt holders and pensioners, like in 2008? And what infrastructure will still be standing, useful and cheap to acquire on the other side? Those are the questions a real economist asks. Bubble or no bubble is the question a guy on Twitter asks before going long Nvidia leaps. So for the rest of this video, we're not going to ask whether it's a bubble. We're going to dissect the mechanics, the bull case, the hidden leverage, the circular financing, the productivity gap, the power constraint, and the historical parallel that almost everyone gets backwards. By the end, you'll see why everyone is wrong, and what being right actually looks like. If that sounds useful, hit the subscribe button now, because we publish this kind of analytical, unsexy economics content twice a week. And YouTube's algorithm is currently in a relationship with whoever screams loudest. Help us out. 2. The bull case. Argument. Why the smart money says this time actually is different. Okay, let's do something the bears almost never do, and the bulls do badly. Let's actually see the case that the AI build-out is rational, sustainable, and not a bubble in any meaningful sense. Because if you can't honestly explain why a guy like Stanford Professor Gilad Allen or Goldman Sachs' research desk thinks the bears are nuts, you don't get to call yourself analytical. You're just vibing. Here's the strongest version of the bull case, and I want you to actually sit with it for a moment. Argument 1. This isn't being financed the way previous bubbles were. When the dot-com bubble inflated, telecom equipment company Lucent Technologies had over $15 billion in vendor financing, meaning they were lending money to their own customers so those customers could buy Lucent products, against operating cash flow of only about $300 million. That's a 50-to-1 ratio of fake demand to real cash. WorldCom signed take-or-pay contracts for capacity that didn't exist for customers that didn't exist either. When the music stopped, the debt cascade triggered a credit unwind. The bull's point, the hyperscalers today, Microsoft, Google, Amazon, Meta, are funding their AI build-outs primarily out of operating cash flow. These are some of the most cash-rich companies in human history. Microsoft generated over $100 billion in operating cash flow last year. Google's cloud backlog alone, meaning contracted, signed, committed future revenue, exceeds $460 billion. That's not vapor. That's enterprises actually committing to spend. Argument 2, capex as a share of GDP is still well below historical bubble peaks. This one is genuinely uncomfortable for the bears. According to Goldman Sachs, AI capex recently equated to roughly 0.8% of US GDP. Compare that to previous infrastructure manias. Railroad investment hit 6% of US GDP in the 1870s, and overall information processing investment briefly reached 1.5% of GDP or higher during prior tech booms. Even the British Railway Mania peaked at a stunning 13% of UK GDP in 1845. We are not, by historical infrastructure spend standards, at an unprecedented level, at least not yet. The bull says this is a big build-out, not a mania. Argument 3, the revenue is showing up. This is the argument the bulls find most satisfying, and it's not stupid. Q1 2026 saw S&P 500 earnings growth of 27.1%, the kind of number you typically only see in a recovery from a recession, except there's no recession to recover from. Where's that growth coming from? Disproportionately from AI infrastructure, chips, hyperscalers, memory, and cloud computing. Nvidia alone posted $215.9 billion in FY 2026 revenue at 71% gross margins and roughly 53% net margins. For context, that's not a Cisco 1999 multiple of fantasy, that's an oil major's margins on top of a software company's growth rate. If this is a bubble, it's a bubble that prints actual cash. Argument 4. Efficiency is improving faster than spending. Google publicly disclosed reducing Gemini serving costs by 78% over 2025. Per-task AI energy consumption is falling at, per the IEA, a rate unprecedented in energy history. Every previous compute wave looked expensive at the start and got radically cheaper once scale kicked in. Cloud computing did this. Smartphones did this. The bull's point: don't price today's costs into tomorrow's economics. Argument 5. The geopolitical flaw. This is the one nobody talked about in 1999, and it changes everything. Sovereign AI is now a national security category. The US, the UK, Japan, France, Saudi Arabia, the UAE, and increasingly India are all treating domestic AI compute as critical infrastructure on par with semiconductors and energy. The Stargate project, before it ran into recent trouble, had a stated $500 billion ambition. Middle Eastern sovereign funds are pouring tens of billions into local data centers. China is replicating the entire stack. This means even if commercial demand wobbles, government demand provides a price floor that fiber optic cable in 1999 simply did not have. Nobody at the Pentagon cared whether 360 Network survived. Everybody at the Pentagon cares whether Anthropic and OpenAI survive. That's the bull case. And honestly, it's not crazy. There are serious adults at serious institutions, Janus Henderson, Goldman Sachs, the IEA, who look at the data and conclude this is a real, durable, infrastructure-driven cycle. So why isn't that the end of the story? Why am I still going to spend the rest of this video explaining why the consensus is wrong? Because every argument I just made is also exactly what every bull argued during every previous infrastructure bubble. And because the data the bulls cite is real, but the data the bulls don't cite is also real. Let's go find it.
So that's the bull case. And honestly, it's the most coherent version of it you'll hear anywhere. Sit with it for a second, because the next 40 minutes only land if you took it seriously. Now I'm going to show you what the bulls are quietly leaving out, starting with where the leverage is actually hiding.
3. The hidden leverage, where the debt is actually hiding. The bulls' most powerful argument, that this build-out is funded from cash flow, not debt, has a problem. It's true, and it's also misleading. Because the leverage in this system isn't sitting on Microsoft's balance sheet, it's sitting one floor down in places most retail investors don't even know exist. Let's start with a number that should set off every alarm in your head. According to Futurium's Cloud Tracker Pro analysis, in calendar 2025, the 4 biggest hyperscalers, Alphabet, Amazon, Meta, Microsoft, grew revenues by an average of 16.5%, while growing capex by an average of 60%. That's already weird. But for 2026, the same group's plans imply revenue growth of about 15.5%, while capex growth jumps to roughly 80%. Read that ratio. Spending growing 5 times faster than revenue. That's the first crack. When capex outstrips revenue at that pace for that long free cash flow, which is operating cash flow minus capex, starts going in the wrong direction. And it has been. Free cash flow estimates for the hyperscalers in 2026 look, in Futurium's words, abysmal. Now, none of these companies are going to miss a debt payment. They're not going bankrupt. But the cash buffer that was supposed to make AI capex self-funded is shrinking. And as it shrinks, the marginal financing comes from somewhere else. That somewhere else is where the leverage lives. The first hiding spot is the neo-clouds. These are the second-tier compute providers, CoreWeave, Crusoe, Nebius, Lambda, that operate as effectively the leveraged middle layer between Nvidia chips and the AI labs that need them. They borrow against GPU contracts, package those contracts as collateral, and issue debt. CoreWeave alone has raised tens of billions in debt facilities, collateralized by Nvidia inventory, and forward contracts with Microsoft and OpenAI. If those contracts get renegotiated, deferred, or cancelled, if Microsoft decides next year that maybe it doesn't need quite as much CoreWeave capacity, the collateral value of those GPUs collapses overnight, and somebody is left holding leveraged paper backed by depreciating silicon. The second hiding spot is private credit. The non-bank lending market, your Apollos, your Blackstones, your Ares Capitals, has ploughed an enormous amount of money into AI infrastructure financing over the past 2 years. Data center developers borrow from private credit funds. Power deals get structured as project finance. Lease-to-own equipment arrangements are repackaged into credit instruments. Private credit has, in essence, become the shadow banking system of AI. And unlike banks, private credit funds aren't stress-tested, aren't required to disclose much, and aren't subject to the same capital requirements. Per April 2026, reporting from Futurium, troubles in the private credit sector are already a recognised risk overhang on the entire build-out. The third hiding spot is the hyperscalers themselves, but in places that don't show up cleanly. Meta raised its 2026 capex guidance to $125 to $145 billion and openly cited the use of debt and special-purpose financing vehicles to fund parts of it. Oracle, which recently became one of the largest AI infrastructure providers via its OpenAI cloud deal, has issued tens of billions in bonds to fund the build-out. Stock-based compensation, which doesn't hit cash flow but absolutely transfers economic value, has exploded across the sector. A lot of self-funded turns out, on closer inspection, to be self-funded plus a little bond issuance, plus a little private credit, plus a little equity dilution, and those littles are now hundreds of billions of dollars in aggregate. Now here's where the bears have been making a critical error too, so let me tell you the bull pushback before we move on. The bear thesis assumes this leverage propagates the way 2008 propagated, through interconnected bank balance sheets that all mark to market the same collateral. The current AI leverage doesn't quite work that way. Private credit funds have lockups. Pension funds holding their LP interests can't run on them the way depositors ran on Bear Stearns. The hyperscalers themselves have so much liquidity that even a serious contraction in revenue wouldn't trigger a default cascade. So you probably don't get a 2008-style systemic event. What you might get instead is something messier and slower. A years-long unwind where neoclouds default. Private credit funds quietly write down GPU-backed paper. Hyperscaler capex gets cut in half. And per the Information Technology and Innovation Foundation's recent analysis, new AI data center deals already fell more than 40% between Q3 and Q4 of 2025. The $500 billion Stargate project, OpenAI's flagship, is reportedly stalled after disputes between partners. Of the 240 gigawatts of planned US data center construction, only about a third are actually being built. The leverage doesn't blow up in one weekend. It just bleeds out over quarters in places nobody is looking. Which, honestly, is worse for retail investors, because at least 2008 told you when to panic. This time, the signal will be buried in the footnotes of CoreWeave's bond covenants and a single-line item on Meta's 10K. Have fun finding it. 4. The circular money loop. When your customer is also your investor is also your supplier. If you want to understand why even the people making money off the AI boom are nervous, you need to draw the diagram. So let me draw it for you, in words, because YouTube apparently doesn't let me whip out a whiteboard. In September 2025, Nvidia announced it would invest up to $100 billion in OpenAI. OpenAI then committed to spending that money, and significantly more, on data centers built by Oracle, who in turn spent tens of billions of dollars buying chips from Nvidia. Microsoft, which already owns a 27% stake in OpenAI's for-profit business and has invested over $13 billion directly, also receives a revenue share. It pulled in roughly $865.8 million in just the first 3 quarters of 2025 from that arrangement, per leaked documents. Meanwhile, AMD struck deals with OpenAI worth around $200 billion and handed over equity warrants for 10% of AMD itself as part of the package. Broadcom committed to a custom chip arrangement worth roughly $350 billion through 2035. Tally up OpenAI's announced infrastructure commitments, and you arrive at a number that should make you put your coffee down. $1.15 trillion in obligations spread across Broadcom, Oracle, Microsoft, Nvidia, AMD, AWS, and CoreWeave between 2025 and 2035. OpenAI's projected 2026 revenue, roughly $20 billion. OpenAI's projected 2026 losses, $14 billion. So, a company losing $14 billion a year with $20 billion in revenue has signed contracts worth $1.15 trillion. And the companies on the other side of those contracts are, in many cases, the same companies that are funding OpenAI in the first place. This is what economists politely call circular financing. What it actually is, Nvidia gives OpenAI $100 billion. OpenAI gives that $100 billion plus more to Oracle and CoreWeave. Oracle and CoreWeave give it back to Nvidia for chips. Nvidia books that as record revenue, its stock goes up, which lets it raise its own equity to fund more investments into OpenAI. The wheel spins. Everybody books revenue. Everybody books growth. Everybody's stock prices climb. The S&P 500 hits new highs. Now, the bull's response to this, and I have to credit it because it's not a stupid response, goes like this. So what? AI compute is genuinely scarce. The most advanced chips have multi-quarter lead times. Of course, suppliers are co-investing with customers. Of course, there are equity stakes and revenue-sharing arrangements. This is just modern industrial finance. Janus Henderson called it a virtuous circle that helps line up suppliers and customers to meet exploding demand. That's a fair point. Co-investment between a chip maker and its largest customer is not, by itself, evidence of fraud or even of a bubble. Intel did it. TSMC does it. Every cycle in semiconductors has involved some version of this. The problem is the scale and the concentration. When you have over $800 billion in circular financing arrangements sloshing around an industry where one company, OpenAI, sits at the center as both the largest customer and the largest object of investment, you have a structure that is mathematically equivalent to one of the most spectacular accounting failures of the dot-com era. I'm going to say a name now that the bulls really hate hearing: Lucent Technologies. In 1999 and 2000, Lucent was a darling of telecom investing. It sold equipment to phone and internet companies. It also lent those companies the money to buy that equipment. At its peak, Lucent had over $15 billion in vendor financing on its books, an operating cash flow of around $300 million. When the telecom companies started failing, Lucent had to write down billions, took massive losses, and its stock price eventually collapsed by over 99%. The pattern: vendor financing inflates revenue. Inflated revenue inflates the stock. Inflated stock funds more vendor financing. The loop works beautifully until the customer can't pay, at which point the collateral, the revenue, and the stock all collapse together. Now look at what's happening today and ask yourself the uncomfortable question. How much of Nvidia's record revenue is coming from companies that exist primarily because Nvidia funded them? How much of Oracle's stock surge is built on cloud contracts, dependent on OpenAI's still unprofitable business model? OpenAI's revenues remain tiny compared to the scale of its commitments. That's not me editorializing. That's how Calculus Tech described it. Here's the part that genuinely separates this from 1999 though, and it's the bear's blind spot. Even if OpenAI never makes money, the physical infrastructure, the data centers, the chips, the fiber, the power contracts, doesn't disappear. When Lucent imploded, the companies that owed it money imploded too, and most of the equipment went obsolete in months. AI compute infrastructure has a depreciation schedule of 3 to 6 years on the chips, and 20 plus years on the buildings, the substations, the cooling systems. Even in a bust, that infrastructure gets bought up by survivors at pennies on the dollar, and probably runs the next decade of AI applications. So the circular financing is real, the risk is real, the Lucent parallel is uncomfortably tight. But the assets being financed are durable in a way fiber optic cable in Kansas in 2001 was not. Both things, again, can be true.
If you're watching this and quietly recalculating your portfolio, pause and hit subscribe. We do this kind of breakdown twice a week. Drop a comment with which AI company you think implodes first. I will read them. Now, about whether AI is actually doing anything productive.
5. The productivity paradox. Where the hell is the value actually showing up? Here's the part where I get to feel personally annoyed. Because if you listen to AI bulls, the proper evangelical Mark Andreessen tweeting from a yacht kind, you'd think we are currently living through the largest productivity boom in human history. They will gesture at Q1 2026 GDP growth of 2%, at the 27.1% S&P earnings growth, at the screenshots of ChatGPT writing wedding speeches, and they will tell you that AI is already remaking the economy. So let me share a number that should haunt every investor pricing AI stocks at 30, 40, 50 times sales. According to the National Bureau of Economic Research, as of February 2026, roughly 80% of US companies report using AI. That sounds like an overwhelming productivity revolution until you read the next sentence in the same report. Close to 90% of those companies say AI has had little impact on their business so far. 80% are using it. 90% of users say it's basically not doing anything yet. PwC's 2026 AI Performance Study, which surveyed 1,217 senior executives across 25 sectors, lands on an even more uncomfortable finding. 74% of AI's economic value is currently being captured by just 20% of organizations. 3/4 of the gains going to 1/5 of the companies. The other 80%? Stuck in pilot mode, running internal proofs of concept, building chatbots that nobody uses, hiring a head of AI whose job is mostly to attend conferences. Now, the bulls will tell you this is just the J-curve, the well-documented economic phenomenon where new general-purpose technologies look unproductive at first, because the complementary investments, new processes, new skills, new organizational structures, take years to build. Brynjolfsson, Rock and Syverson literally wrote a paper called The Productivity J-curve about exactly this. Electricity took 40 years to deliver factory productivity gains, because factories had been designed around centralized steam power and had to be physically rebuilt around distributed electric motors. The internet took roughly 2 decades to show up convincingly in the productivity statistics. So the bull says, chill, the gains are coming, you just can't see them yet. And, credit where credit is due, that argument has some real evidence behind it. The Penn-Wharton budget model, one of the more rigorous attempts to project AI's macroeconomic impact, estimates AI will increase US productivity and GDP by 1.5% by 2035, nearly 3% by 2055, and 3.7% by 2075. That's real money. That's a permanent structural lift to economic activity. They also estimate it could reduce federal deficits by $400 billion over the 2026 to 2035 budget window through faster growth and additional tax revenue. But, and this is the part the AI bulls quietly skip past, read those numbers carefully. 1.5% GDP gain by 2035. That is the cumulative gain over a decade, not annual. Penn-Wharton's model puts AI's annual productivity boost as strongest in the early 2030s before fading, with a permanent effect of less than 0.04 percentage points per year due to sectoral shifts. Sit with that. Hyperscalers are about to spend somewhere between $4 trillion and $8 trillion on AI infrastructure over the next 5 years, per Bloomberg's projections. And one of the most credible academic models of AI's economic impact estimates the long-run annual productivity gain at less than 0.04%. That ratio, trillions of dollars of capex chasing fractions of a percent of permanent productivity uplift, is the math problem nobody on either side of the bubble debate wants to solve openly. But wait, you say. The St. Louis Fed found AI-related investment is already showing up in GDP growth, equivalent to nearly half of all US GDP growth last year. Surely that proves the bulls right. Here's the dirty trick of GDP accounting. Investment in AI infrastructure is itself counted as GDP, regardless of whether it ever produces useful output. When Amazon spends $44 billion building a data center, that $44 billion goes straight into GDP as fixed investment. It doesn't matter if the data center sits half empty. It doesn't matter if the AI workloads it runs never produce a profitable product. The spending is the GDP. This is exactly what happened with railway investment in the 1840s. The construction itself was a massive economic stimulus, until the speculative wave broke and everyone realized half the lines led nowhere economically useful. Yale's budget lab put it most clearly. GDP growth has been strong, but job growth in 2025 was barely above zero. 15,000 per month in the US. Strong output, weak hiring, which superficially looks like a productivity boom. But productivity data is, in their phrase, noisy, and we may in fact be seeing a productivity boom, but that is still to be determined. If we are seeing it, it is still unclear why. That's the actual academic position right now. We don't know yet. Anyone telling you definitively that AI is or isn't generating productivity is selling something. Usually their book. The honest summary: AI is generating some productivity gains somewhere for some companies, disproportionately concentrated in the largest, most data-mature firms. The aggregate macro signal is muddled by the fact that the AI investment itself dominates the GDP numbers. The actual diffusion of AI gains to the broader economy, to the small business, to the median worker, to the median country, is, charitably, still in its early innings, and pessimistically, may never look the way the bulls promise. Either way, the math problem stands: trillions in spending, fractions of a percent in measurable annual gains, and 3/4 of the value going to 20% of the firms. The bulls don't want to do that math out loud. The bears do the math but conclude AI is fake. The truth, as usual, is in the middle, which is exactly where our final two sections live. 6. The constraint nobody priced in, power, not chips, is the bottleneck. Here's the thing I find darkly funny about the AI bubble debate. The bulls and bears are both arguing about chips, valuations, financing, and customer demand. They're arguing about Nvidia versus AMD, about Stargate versus Project Maven, about whether OpenAI can hit $100 billion in revenue by 2029. They're arguing, in other words, about software and silicon problems. Meanwhile, the actual binding constraint on the entire industry is something far more boring: electricity. Let me walk you through some numbers that, once you see them, you cannot unsee. A single AI inference task, one query to a large language model, can consume up to 1,000 times more electricity than a traditional Google web search. That's not a typo, 3 orders of magnitude. Now multiply that by the 16 billion tokens per minute Google is currently processing through Gemini. Multiply it across OpenAI, Anthropic, xAI, Meta AI, Microsoft Copilot, and every other foundation model, then add in training runs, which consume gigawatt hours per model. In 2024, global data center electricity consumption was approximately 415 terawatt hours, about 1.5% of the world's total electricity. By the end of 2026, the IEA's most recent estimates put it at roughly 1,050 terawatt hours. If data centers were a country, they would now be the 5th largest electricity consumer on Earth, sitting between Japan and Russia. Electricity demand from data centers grew 17% in 2025. Global electricity demand grew 3%. Data center demand is growing 6 times faster than the entire planet's electricity demand combined. And here's the part that's actually breaking the AI build-out. The grid cannot keep up. In the United States, hyperscalers and developers have announced over 240 gigawatts of new data center capacity through 2030, equivalent to roughly a 20% increase over current US electricity demand. According to the Information Technology and Innovation Foundation, only about a third of that planned construction is actually being built. New AI data center deals fell more than 40% between Q3 and Q4 of 2025. Capex from the hyperscalers could fall by half in 2026 per ITIF. The reason isn't lack of money. It isn't lack of demand. It's that there is, quite literally, no electricity available to plug the things in. The PJM interconnection, the largest electricity market in the United States, covering the Mid-Atlantic and parts of the Midwest, saw capacity market clearing prices for the 2026 to 2027 delivery year hit record levels, in part because of speculative AI load requests overwhelming forecasted generation. Ireland's grid regulator now requires data centers to demonstrate on-site generation capability before granting connections. Data centers there already account for 21% of national electricity demand, projected to hit 30% by the early 2030s. Ireland is, in effect, choosing between AI infrastructure and powering its own population. This has triggered an industry-wide shift to what insiders now call BYOP, bring your own power. The phrase used to be a joke. It is now a defining underwriting model for the next generation of AI infrastructure. Hyperscalers are building natural gas generation directly behind the meter. They're signing 45 gigawatts of conditional offtake agreements with small modular reactor nuclear projects. up from 25 gigawatts at the end of 2024. They're funding microgrids, captive power systems, hybrid energy stacks, long-duration battery storage. Data centers in 2026 are no longer customers of the electricity grid. They are competitors to it. And this is where the bubble debate gets really uncomfortable, because the power constraint cuts in two directions at once. On one hand, it's bullish for infrastructure. Every gigawatt of generation, every substation, every gas turbine, every nuclear SMR contracted today is a real, durable, physical asset that will produce electricity for 30 to 50 years regardless of what happens to OpenAI's stock. Even if the AI bubble pops, the power infrastructure built to feed it gets repurposed for industrial reshoring, EV charging, electrification of heating, cryptocurrency, or whatever the next compute boom is. This is exactly the railway pattern. The track persists even when the equity doesn't. On the other hand, it's bearish for the AI build-out as currently priced. The Hyperscalers' aggressive 2026 capex guidance, $200 billion from Amazon, $190 billion from Microsoft after a $25 billion upward revision for hardware costs, $175 to $185 billion from Alphabet, $115 to $145 billion from Meta, assumes they can actually find the megawatts to power the chips they're buying. Gartner has projected that power shortages will restrict 40% of AI data centers by 2027. That's not a fringe forecast. That's the consensus baseline. Translation: even if every assumption the bulls make about AI demand is correct, even if OpenAI hits its revenue targets, even if enterprise AI adoption finally breaks past the pilot stage, there may not be enough electricity in the developed world to actually run the workloads the spending implies. The bottleneck migrates from chips to power, and from power to permitting, and from permitting to natural gas pipeline capacity, and from there to copper for transformers, and from there to the cooling water needed for hyperscale facilities, which is itself becoming a constraint in places like Arizona and Spain. Here's the dry economist version of the punchline. The AI bubble is unlikely to pop because of a Lehman moment. It is far more likely to pop because of a transformer shortage in Northern Virginia. That sentence sounds like a joke. It is not a joke. The Allianz research analysis from March 2026 explicitly notes that utilities capex grew 20% in 2025 and is projected to grow another 15% in 2026, but is still lagging data center demand. Meta cited higher component and data center costs as the explicit reason for its capex increase. The ceiling on AI growth is no longer a software problem or a financing problem. It's an industrial problem. And industrial problems, unlike software ones, do not get solved at the speed of GitHub commits. They get solved at the speed of building a substation in rural Texas, which is to say, years. So when somebody confidently tells you AI capex will keep growing 50% plus annually through 2030, ask them where the electrons are coming from. Most of them have not thought about this. Most of them will keep not thinking about it, right up until the moment a major hyperscaler quietly cuts its capex guidance in a footnote and the market figures out, 3 quarters too late, that the bottleneck was never the silicon.
A transformer shortage in Virginia. That's what might pop the AI bubble. Not Wall Street, not the Fed. A piece of utility equipment most people couldn't pick out of a lineup. Okay, let's pull all of this together, because the answer to, is it a bubble, is finally going to make sense.
7. What right actually looks like. The synthesis. Both sides. Avoid. So if everyone's wrong, what's right? The answer is uncomfortable because it doesn't fit on a chiron. It's not bubble or no bubble. It's not buy or sell. It is instead a framework. And once you internalize it, the entire AI debate becomes radically clearer. Here is the framework. 3 things are happening simultaneously, and all 3 are real. First, AI is a genuine, foundational, general-purpose technology. Not a fad, not crypto, not the metaverse. The capabilities are real, the use cases are accumulating, and the long-run productivity contribution is, per the Penn-Wharton model and pretty much every credible academic estimate, positive but modest, somewhere in the range of a permanent 1.5% to 4% boost to GDP over decades. Think electricity. not steam engine. Think a slow, transformative diffusion that takes 20 to 40 years to fully show up in the data, not an overnight revolution. Second, the financial structure built on top of that real technology is, by every historical indicator, in bubble territory. The Schiller Cape at 40, matched only by 1999. 5 companies controlling 30% of the S&P 500. 80% of US stock market gains in 2025 coming from AI-related names. Roughly 54% of fund managers calling AI stocks a bubble, per Bank of America's survey. Over $800 billion in circular financing arrangements between vendors and customers. AI startups raising at multiples that, in PwC managing partner Brian Yo's words, represent astronomical multiples for minimal revenues. This is what bubble conditions look like. Not maybe, definitionally. Third, the infrastructure being built, the data centers, the power generation, the chip fabs, the fiber, the substations, is durable, reusable, and will outlive any specific company that goes bankrupt during the inevitable shakeout. This is the railway lesson properly understood. Roughly 90% of railway companies in 19th century Britain went bankrupt. The track is still there. Roughly 90% of dot-com companies failed. The fiber is still there, and YouTube, Facebook, and Netflix were built on top of it. AI will follow the same pattern. Most of the labs, neo-clouds, and AI pure-play startups currently raising at $100 billion valuations will not exist in 2035. The data centers, the power contracts, and the chips will. Somebody, probably the hyperscaler with the strongest balance sheet, probably one we already know by name, will buy them at a discount and run the next decade of compute on top of them. If you hold those 3 statements together at the same time, the implications follow naturally. For investors, the technology is real, the timing is treacherous, and concentration risk is screaming. The smartest historical move in Railway Mania was not to buy railway stocks. It was to buy steel, land, and engineering firms. The smartest historical move in .com was not to buy pets.com. It was to wait, then buy fiber assets at pennies on the dollar. The likely smartest move now is similar. Own the picks and shovels, power generation, transformers, copper, nuclear, rather than the labs, and assume that the consumer-facing AI winners are probably not the ones currently most hyped. For workers, the disruption is real but slower than the panic suggests. PwC's data shows AI's gains accruing primarily to capital owners and the top 20% of firms with the scale to deploy it. US monthly job growth in 2026 is projected to hover around 40,000, with productivity gains absorbing what would otherwise be hiring. AI doesn't create one giant unemployment shock. It slowly reshapes the labour market, with a 2 to 4 quarter lag between corporate adoption and consumer-side employment effects. Adapt now, not later. For policymakers, the build-out is increasingly framed as a national security imperative, which means even a financial bubble pop will not stop the underlying spending. The Pentagon, the EU, and Beijing all view AI compute as critical infrastructure. This is structurally different from 1999, when nobody at NATO cared about WebVan. It also means government subsidy and procurement will likely cushion the inevitable bust, socialising some of the losses while the upside remains private. And for everyone else, ignore the people telling you AI will definitely revolutionise everything by next Tuesday. Ignore the people telling you it's all a fraud. Both groups are flattering themselves. The reality is duller and more important. A real technology, a real bubble, and a real infrastructure legacy, all unfolding at the same time on different timelines, with the bills coming due in different places. 8. Closing thoughts. The single most quoted line from Sam Altman's now infamous dinner is the one we opened with. Someone is going to lose a phenomenal amount of money. We don't know who. That is, on reflection, the most honest sentence anyone in the AI industry has uttered in 3 years. It is also, almost certainly, the only thing about the AI bubble debate on which the bulls and bears would agree. The takeaways. 1. Every infrastructure mania in history has been simultaneously a bubble and a revolution. 2. The leverage in this cycle is hiding in neoclouds, private credit and footnotes, not on hyperscaler balance sheets. 3. The circular financing between Nvidia, OpenAI, Oracle, AMD, and Microsoft is the single most uncomfortable parallel to Lucent's vendor financing of the late 1990s. 4. The productivity gains are real but modest, concentrated, and slower than the spending implies. 5. The binding constraint is now electricity, not chips, and a transformer shortage in Virginia could pop this bubble before any financial trigger does. 6. Whatever happens to the equity, the infrastructure persists, and that persistence is what makes bubble or revolution a false binary. If you want the deeper plumbing of how circular financing structures work historically, go watch our breakdown of the petrodollar's decline. The structural erosion, not collapse framework applies here too. If you want to understand the electricity constraint properly, our piece on Saudi Vision 2030 covers how sovereigns are now structurally tied to compute infrastructure. The links are in the description. Thank you for sitting through 40 minutes of an economics video that refuses to give you a clean buy or sell. If you valued the analysis, hit like, leave your bubble pop date guess in the comments and subscribe. We'll see you in the next one.